Hi, let's start with the concept capsules for today. The topic that we're going to look at is the evolution of portfolio theory. So we'll start with the minimum variance frontier, then we move on to the efficient frontier. From there, we go on to the capital allocation line, then the capital market line, and then to the security market line. So our focus is not going to be on the formulas, but on the various phases and how they are different from each other and how we go from one phase to the next phase. And basically what is the main difference in all of these phases and how do we actually arrive at the final formula that is for the capital asset pricing model and the security market line essentially. So let's start with the minimum variance frontier first. All right. Now what is the minimum variance frontier? Now let's say you've been given information about 20 different assets. So you know the risk and return profiles of all of these 20 assets and you put them on an Excel sheet and create various portfolios out of those. Now, of course, you could do this manually as well, but it's not going to be that easy. And on an Excel sheet, it's just going to be a matter of seconds that you'll be able to create such portfolios. Now, once you have calculated all these various portfolio combinations, when you combine all the minimum variance portfolios together, that would essentially form the minimum variance frontier. Now, what is this minimum variance frontier going to look like? That's what we're going to see on the next slide. Now, on this minimum variance frontier, we will have one specific point, which will have the least amount of variance. Essentially, that's the least risky point on the entire frontier. That is what we are going to call as the global minimum variance portfolio. Now we'll use this global minimum variance portfolio as a benchmark to look at where the efficient frontier lies. So let's have a look at this. Now this is your efficient frontier. Now let's understand the space that we are going to work in. In portfolio theory, we take the same things on the X and Y axis. Usually on the Y axis, you have the portfolio's expected return. And on the X axis, we have the risk. Now, what we need to understand is that even though we are saying that we are putting risk on the x-axis, the way we are going to define risk is going to change over the various phases. So right now, the way we define risk is by using the portfolio standard deviation, which is a measure of total risk. So keep an eye out on the x-axis because the risk measure is eventually going to change. So remember, risk on the x-axis and return on the y-axis, that is the space that we are going to work with in portfolio theory. Now what we do is, we plotted all the 20 different portfolios that we had, and we created this minimum variance frontier. So this is the frontier, the curve that you see, the entire curve starting from here, right till here, that is your entire minimum variance frontier. Now on this frontier, we identify one single point which has the lowest amount of variance. Basically, it's the least risky of the portfolios. So when we can see clearly that risk is on the x-axis, that means the point which would be towards the left side, the leftmost point on this frontier, that will be the global minimum variance portfolio. That means it's the least risky of all the available portfolios that we have. So that's going to be the leftmost point, what we have here. So that's your global minimum variance portfolio. Now, the next thing that we need to identify is something that we call as the efficient frontier. Now, what do we really mean by efficient frontier? Now, let's take an example of the portfolio A and B to understand this concept. Now, pay attention to the expected return and the standard deviation, basically the risk of these portfolios. So if we compare A and B, you see that the amount of risk is actually exactly the same. But when we look at the expected return, you can clearly see that A is giving you a much higher return compared to B. You can see that being plotted here. So the return of A is way higher than return of B, but the risk is the same. So needless to say, no rational investor will ever go for B over A. You'll always select A over B because it is giving you a higher amount of return for exactly the same level of risk. That is essentially what we mean by an efficient portfolio. So efficient portfolio would mean that it's that portfolio which is maximizing the return for a given level of risk, or alternately, for a given level of return, it is minimizing the amount of risk. Now, if we apply this concept to the entire minimum variance frontier, you can see that all of these points, so all of these red stars that you see, all of these are inefficient, because for every single star, you can actually create, or you can actually select another point on the upper side of the minimum variance frontier, which has a higher amount of return for exactly the same level of risk. And this will hold true for every single point below the global minimum variance portfolio. So essentially every point below this is going to be inefficient, because if you select any of these portfolios, you can always move up on the upper side of the minimum variance frontier, and that point or that portfolio is going to give you a higher return for the same level of risk. So all of these points on the lower side are inefficient, and we're not going to consider this for portfolio theory. So we're not going to include that in our analysis going forward, because these are inefficient. So where is the efficient frontier? Essentially everything to the right of this global minimum variance portfolio, everything on the upper side, starting from here till here, that is your efficient frontier. So that's your efficient frontier. That consists of dominant portfolios. Dominant essentially means that these are the portfolios which are dominating all the other portfolios on the lower side as well as the portfolios in the middle. So these are the best portfolios as far as your risk and return trade-off is concerned. So that's your efficient frontier. Now, the next thing that we look at is an example to understand this better. Now, which statement best describes the global minimum variance portfolio? Remember, that is the point that we just saw. That was the leftmost point. Now, the global minimum variance portfolio gives investors the highest level of returns. B is it gives investors the lowest risk portfolio made up of risky assets. Or the global minimum variance portfolio lies to the right of the efficient frontier. Now, for point A, it gives the investors the highest level of returns. We didn't talk about the returns at all. We were always talking about the risk aspect because we're talking about variance. So the minimum variance portfolio reflects the risk part rather than the return part. So A cannot be the answer. And the global minimum variance portfolio gives investors the lowest risk portfolio made up of risky assets. So that is obviously the definition, because this is the least risky portfolio on the minimum variance frontier that we have. The third one, the global minimum variance portfolio lies to the right of the efficient frontier. Again, that's wrong, because we saw that this point was the leftmost point on the entire curve. So it lies to not the right, but the left of the efficient frontier. So the correct answer is B. Now, after efficient frontier, the next thing that we look at is the CAL, the capital allocation line. Now, till now, what we have done is we have only looked at the risky assets. We have not considered the possibility of including a risk-free asset in the portfolio. So that's exactly what we do in capital allocation line. So we combine a risk-free asset with the risky asset. Now, by definition, risk-free asset is something that is not going to carry any risk, but it's still going to give you the risk-free rate of return. So that's why it plots exactly on the y-axis. Why? Because it does not have any risk, so it's not moving to the right at all. That's why it's the intercept term that you have. So that's your risk-free asset. Now that's your capital allocation line. So this will be the expected return of the portfolio of the asset, and then you have the standard deviation of that. And of course, we are still in our familiar space. That is the expected return of the portfolio and the standard deviation of the portfolio, which is essentially the proxy that we are using for the risk of the portfolio. Now the thing is that the investor can invest anywhere on this CAL, the capital allocation line. So how do we figure out which point is optimal, which is the point which is suitable for the investor? The point could be here, it could be here, it could be anywhere. So how do we decide on that? For that, we use indifference curves. In order to get the optimal portfolio, we combine the indifference curves with the capital allocation line. Now, what do the indifference curves do? they essentially express the preferences of the investor. What is the investor, comfortable? Where is the investor comfortable investing in? So it's essentially saying that this is the level of risk that the investor is willing to take for a particular level of return. So these are the indifference curves that we have. Which will be the optimal portfolio in this case? You have the original capital allocation line. Remember, the problem was where exactly on the capital allocation line is the investor going to actually invest? What is optimal for him? So that is going to be the point where your indifference curve, essentially your CAL, is tangent to the indifference curve. So this is going to be the point which is going to be optimal for the investor. Now CAL is investor specific. We're just drawing it for one particular investor. The next part in the evolution is that we change the CAL to the CML, which is the capital market line. Now, how do we do that? We have to make certain assumptions. So if we standardize the assumptions, if we say that the preferences of all the investors are exactly the same, that means all the individual CALs are going to converge to the CML, which is the capital market line. Now, this was our original efficient frontier. If you remember, that's what we created, the upper part of the minimum variance frontier. So that was the efficient frontier. And that's your capital market line. The part where the CML is tangent to the efficient frontier, that is essentially going to be the market portfolio. Now, in real life, one of the drawbacks of the theory is that there is no true proxy for the market portfolio. Because if you look at any investor, their investments are not limited to only equities or only bonds. They would be investing in commodities as well. They might have got jewelry. They might have got real estate. Now, there is no index in the world which is a true proxy for that market portfolio for all the various investments that a person could have. So usually what we do is we use any of the popular equity indices as proxy. So let's say an S&P 500. But of course, that is the drawback of the theory because we don't have a perfect market portfolio, so to say. So that's your CML and that's your efficient frontier. Remember, right now we're still in the old space only. We have the portfolio return. That's not going to change anyway. That still remains the same across the entire portfolio theory. However, this definition is going to change. Now, why is it going to change? When we talk about the standard deviation of the portfolio, we're actually referring to the total risk. Now, total risk is made up of different components. So that's what we're going to see. Now, within total risk, we're dealing with two different types of risks. Now, what are these? We have the systematic risk and the non-systematic risk. Now, systematic and non-systematic risk. Now, what is the difference between the two? Systematic risk is essentially that part of the total risk that you cannot get rid of. So no matter how many securities you keep purchasing, you just cannot get rid of this risk. So the popular examples would be most of the macroeconomic risks that you have. So let's say inflation, interest rate, exchange rate. So all of those are considered to be systematic in nature. Non-systematic risks are the specific risks which are being faced by a particular company. So things like, let's say, the CEO resigning or the employees going on a strike, all of these will be specific to one particular company. So for instance, let's say if the CEO of one company resigns, it's not like the CEO of all the other companies are also going to resign at the same time. So that's a risk which you can easily get rid of. You can easily diversify by investing in more and more securities. Now, till now, the theory has been that the market is rewarding you for the total risk. That means the market has been rewarding you for both systematic as well as non-systematic risk. Now, the next thing that we change in the theory is that non-systematic risk is something that you can get rid of. So why should the market be rewarding you for that? So the point is that if you do not diversify, if you do not increase the number of securities in your portfolio, then it's your fault. Why should the market be compensating you by giving you extra return for it? So market should only be compensating you for that risk that you cannot avoid, that you cannot get rid of. And that is the systematic risk. So investors will get compensated only for bearing the systematic risk. Now here is an illustration to to show the difference between systematic and unsystematic risk. So you have risk here and you have number of securities in a portfolio. So when you keep increasing the number of securities, you're getting more and more diversification benefit, as long as the correlation is not perfect, as in it's less than +1. So when you keep increasing the number of securities in the portfolio, that is there on the x-axis, you see your systematic risk is going to remain constant because you cannot get rid of that. However, the unsystematic risk part of it keeps going down. It keeps declining. So this is what you are able to avoid, what you are able to reduce by increasing the number of securities. But systematic risk cannot be reduced, and that's the reason why market should be rewarding you for systematic risk and not unsystematic risk. That gets us to the next phase in the portfolio theory. So right now we were at the capital market line. The next thing that we saw, or the next thing that we look at, is the SML, the security market line. Now SML is the final thing in this evolution that we are looking at, and that is also going to give us the formula for CAPM. CAPM is essentially the equation for SML. So it's a representation of CAPM with beta reflecting the systematic risk. Now, what is the similarity to CML? Now, if you look at the space, you still have expected return on the y-axis. However, if you look at the x-axis, we don't have the standard deviation anymore. We are only including the systematic risk, which is being measured using the beta of the portfolio. So instead of using total risk, we are using a narrower definition, which is only the systematic risk, because we are getting rewarded for systematic risk part, not the total risk. Now the equation is the capital asset pricing model, the CAPM model. So you have expected return that is given by the risk-free rate plus beta times the market risk premium, that's expected return of the market minus the risk-free rate. So that's what we have for the capital asset pricing model. Now let's look at the SML. So instead of the CML, now we have come to SML, and we have changed the definition of risk from total risk, which was measured using standard deviation, to the beta of the portfolio. Now in this case, the slope is RM minus RF, which is essentially the market risk premium or the equity risk premium. That is what the slope is. And if you look at the y-intercept, that is basically just the risk-free rate. Now, how do we interpret the security market line? The interpretation is that all the portfolios that are properly priced will plot on the SML. They will lie exactly on the SML. Now, what do we really mean by properly priced securities or portfolios? Properly priced means that your required return and your expected return is exactly the same. That means that the market value and your intrinsic value is the same. So another way to put that is that the securities are neither overvalued nor undervalued. They are fairly valued, they are properly valued. So SML is the set of all of those securities that are properly valued. So they are going to lie on the SML. Now let's look at a question to understand this. The question is that an overvalued security would most likely plot where? Would it be below the SML, on the SML, or above the SML? Now, on the SML is clearly the wrong answer, because we just said that only the properly priced securities are going to plot on the SML. So this, of course, cannot be the answer. It has to be either below or above. Now, how do we determine this? Again, no need to memorize this if you understand the basic diagram of SML, because this is something that people do really get confused with. And this kind of question does come up in the exam. So you need to know using the SML that what is overvalued and what is undervalued. Now let's look at this SML. Let's say you have a security that plots here. Let's call it A. Now in this case, for A, look at the return that is expected or that is given by your CAPM model. That would have been here. So for this particular security, the level of risk is here. Just join this line to the x-axis. So that is the beta. So the level of risk is this, but the level of expected return is much higher than what you expected. So this security A is giving you much higher return than what you required for this level of risk, because you were happy getting this amount of return, but this security is expected to give you even higher return than that. So what should you do? It's giving you more return than what you expect at that particular risk level. So of course you should go ahead and buy it. So if it is plotting above the SML, that means it is undervalued. It's giving you a higher return than what you require for that level of risk. Similarly, if a security is plotting below the SML, so you have security B here, for the same level of risk, it's giving you a lower return than what you require. So it's not compensating you adequately for the risk that you are taking. So this means that it is going to be overvalued. So you're not going to buy it. If possible, you will short the security. So your correct answer is A. So if it is below the security market line, that is an overvalued security. So if security lies above the SML, it's underpriced, so you should go long. So remember, whenever something is underpriced, you should be buying it. You should be going long on that. If it lies below the SML, it is overpriced. So you should, if possible, just short it. So that was the evolution starting from the minimum variance frontier right onto the security market line and the CAPM model.